The tokenization of real-world assets acts as a precise infrastructure bridge. It connects traditional off-chain financial claims directly to the immutable ledger of the blockchain. This digital asset taxonomy isolates exactly what we are discussing. Tokenized real-world assets, or RWAs, sit in a distinct category from native cryptocurrencies like Bitcoin or regulated stablecoins. Cryptocurrencies derive their value from network utility and market speculation. RWAs derive their value from legally binding claims on existing offline assets, specifically physical property, commodities, or private corporate credit. Private equity, global real estate, and fixed income bonds represent a multi-trillion-dollar pool of capital. Historically, these asset classes operate with high friction and deep illiquidity. Bringing them on-chain is an attempt to optimize their distribution. The technology maps institutional-grade legal contracts onto programmable digital rails. Traditional private credit markets enforce strict barriers to entry. Institutional funds regularly require million-dollar minimum commitments and mandate lockup periods lasting 7 to 10 years. Tokenization replaces that analog gatekeeping with an algorithmic fractionalization process. Multi-million-dollar credit portfolios are chopped into distinct, manageable digital tokens that can be traded instantly. This alters the mechanics of settlement. Traditional markets still rely on a T+2-day settlement cycle, requiring a 2-day delay to clear capital. Smart contracts execute settlement instantly, which enables investors to accrue yield intraday rather than waiting for month-end distributions. Regulatory requirements do not disappear, they become programmable. Code dictates the transfer mechanics, baking KYC and AML verifications directly into the token's architecture to execute. Fractionalization takes static, heavily gated wealth generation and converts it into a borderless network accessible to retail capital. Pricing these assets introduces a severe technical friction. Private credit does not trade on an open exchange, meaning there is no live price feed for an on-chain oracle to read. This chart contrasts DeFi spot pricing with RWA net asset value. Spot pricing fluctuates continuously via open market trades. The RWA NAV operates as a rigid step function, updating daily. Off-chain administrators manually calculate book value and interest, pushing that data point to trigger the step. A daily pricing mechanism clashes with the reality of a 24/7 blockchain. Investors attempting to trade these tokens intraday are effectively trading blind to real-time valuation shifts. Because private credit tokens rely on delayed administrative estimates instead of real-time market discovery, significant friction is baked directly into the secondary trading market. Despite this pricing friction, retail capital is aggressively pursuing tokenized credit. The primary incentive is the target yield, which consistently hovers between 6 and 10%. This chart measures the 6-month risk-reward ratios of major asset classes using the Sharpe ratio. Baseline crypto assets like Bitcoin and DeFi tokens display highly lackluster risk-reward performance compared to traditional safe havens like gold or US indices. To capture steady returns, retail investors turn to the private credit ETF wrapper. This structure aggregates high-yield private debt instruments into a single, easily purchasable vehicle. The retail assumption is that wrapping an asset in an ETF format mathematically ensures daily liquidity, providing the ability to exit a position at any moment. Retail investors are trading crypto volatility for the stability of traditional finance yields. In doing so, they assume the digital wrapper erases the strict illiquidity of the underlying corporate debt. Deploying 24/7 trading software does not mathematically manifest buyers for assets that no one wants to purchase. This creates the liquidity paradox. In times of stress, volatile retail capital demands rapid redemptions, forcing immense pressure against the underlying corporate loans, which are structured as static lockups. To survive the mathematical mismatch, the ETF pressure valve snaps shut, locking the remaining capital inside. This systemic vulnerability is compounded by fragmented, decentralized exchanges and a severe lack of dedicated market makers willing to absorb the spread. Packaging structurally illiquid assets into a highly liquid wrapper is a structural illusion. When systemic shocks hit, the illusion breaks, trapping retail capital inside the fund. Decentralized finance lending protocols provide a structural alternative to the volatility of secondary market fire sales. Rather than searching for a buyer on an open market, an investor can deposit their tokenized credit asset directly into an established lending pool, using it purely as collateral. The mechanism works in a tight loop. The RWA token locks into a smart contract vault. The contract instantly mints and releases a proportional amount of stablecoins to the user, providing immediate capital without requiring an asset sale. In traditional finance, extracting capital from a private credit position before the multi-year lockup expires is virtually impossible. DeFi composability solves the early exit problem. Retail investors extract instant liquidity to deploy elsewhere, while the underlying private credit investment remains entirely intact. What happens to the protocol when a borrower defaults on a tokenized physical loan? In standard DeFi, if a user's collateral drops in value, the protocol instantly liquidates their ERC20 tokens on an open exchange. You cannot algorithmically auto-sell a commercial skyscraper or a batch of freight invoices. Seizing physical collateral demands analog intervention. A special purpose vehicle must initiate slow, real-world legal proceedings in the jurisdiction where the asset resides. While the legal system grinds forward, the smart contract executes immediate technical triage. It enters a default state, freezing all token transfers to prevent market contagion. Tokenization successfully digitizes the issuance of debt, but the ultimate recovery of a defaulted physical asset is bound entirely by traditional, analog law. Because legal recovery takes months or years, institutions rely on algorithmic risk tranching to shield retail capital from the delay. The smart contract divides a credit pool into a secure senior tranche and an exposed junior tranche. Acting as a financial shock absorber, this bottom layer takes the first hit during a default, absorbing losses so the senior tranche remains untouched. If the losses exceed the junior tranche, protocols deploy a secondary buffer. Decentralized insurance funds, often called SAFU, inject protocol capital to cover the remaining outstanding balances of the senior lenders. Retail capital survives systemic defaults through these programmatic shock absorbers. They take the financial hit so the individual investor doesn't have to wait for the physical liquidation. The long-term trajectory for tokenized assets is direct integration into the broader global decentralized finance ecosystem. Automated compliance engines are required to make this function across borders. These engines ensure that complex KYC limits and jurisdictional rules travel seamlessly with the token as it moves between different blockchains. The goal is asset composability. This allows a tokenized slice of commercial real estate or private equity to be plugged directly into advanced collateralization and yield strategies across the network. Achieving true market depth requires multi-chain interoperability to aggregate isolated liquidity pools into a single unified financial layer. The utility of an RWA lies in its execution. It grants the ability to legally and functionally deploy traditional assets across any decentralized financial protocol. Minting a digital token representation of a real-world asset is, surprisingly, just the easiest step in this entire process. The actual engineering hurdle is constructing deep, resilient secondary markets, capable of absorbing severe systemic stress. The structural illiquidity of the underlying asset never disappears. It is strictly managed through the precise application of smart contract pressure valves. Long-term viability depends on a dual mandate: rigorous offline institutional due diligence paired with strict algorithmic on-chain enforcement. With these engineering layers in place, tokenized private credit subjects exclusionary debt to programmatic oversight, integrating traditional finance into the modern retail portfolio through automated risk management.